So this is on the page 13 of the study notes, okay? Like any statement of cash flow question, what you want to do is first you want to have this complete name and the name of statement ready. Okay, so what we're going to do, first, we're going to look at the indirect method. When we do indirect method, we're going to first do cash flow from operating section. Okay, because we're doing indirect method, so first we're going to get the net income. So that's the net income. Then what we're going to do next? We need to make adjustment to the net income to get the cash flow from operating section. So here, the adjustment. For the adjustment, like what I said, you want to do it in a very systematic way. So just not like a randomly pick up the numbers. Instead, I will encourage you to move from income statement to balance sheet. For the income statement, what you should be looking for? You should be looking for all non-cash expenses, losses, gains, and revenue. Okay. So here, look at this Robinson Company. On the income statement, they have two items which are non-cash. Okay. First is a depreciation, and the second one is loss on sale. Here, every time you see these two, you know these are non-cash expenses and losses. So you have to add them back to the net income. Okay, so that's what I'm doing here. I just added it back. I added the depreciation expense, added the losses on sale. Okay. Then I look at the income statement one more time, make sure there's no other non-cash gains and losses and sales and revenue. What we're going to do next after you finish the income statement is you have to move to the balance sheet. So for the balance sheet, there are two bigger components we should look at, which is the current asset and the current liability. Okay, so current non-cash asset, to adjust for balance sheet, we have to first calculate the changes. Okay, so for income statement, you can just use the item by itself, but for the balance sheet, it has to be the changes from this year, from last year to this year. For question on page 13, there is a column has already calculated changes for you. Okay, but when you do the question at the exam, sometimes you have to calculate it by yourself. But if you have Excel, it's fairly simple. You can just copy paste the question and do a formula to calculate the change. Okay, so now let's look at the current asset. So on current asset, in this question, there are three current assets. Okay, three non-cash current assets. We have account receivables, we have inventory, and we have prepaid expenses. So these are the three items we need to consider. Just remember, if you have an increase in current asset, you need to subtract, and if you have a decrease in current asset, you're going to add. Okay, so this is what I did here. Three items. I subtract the increase in account receivables, add a decrease in inventory, and subtract the increase in prepaid expenses. All right, so that's everything about the current assets. Then I want to move to the current liabilities. So the current liability, there are two current liabilities. First is accounts payable, and the second one is income tax payable. Okay, so if you have an increase in current liability, you need to add, and if you have a decrease, you need to take it out. Okay, so that's what we're doing. We have okay. That's it. We don't have anything like what I said. Look at the income statement, look at the current asset, current liability. That's everything you need to consider for cash flow from operating sections. Here, That's everything we have on the balance sheet, and we can just calculate what is the sum going to be. Okay. Like what I said, the key is really make sure when you do this sum, you have to go all the way to include the net income. Okay. All right. So that gives you 65,000. That's the cash flow from operating section. Okay. All right. So next, what we're going to do is we're going to look at the cash flow from investing activities. So look at it here. For cash flow from investing, so for this cash flow from investing, remember what we talked about last class. What we really want to look at is look at the changes in long-term asset, So here, for the changes in long-term asset, we have the land and we have the building. But you can't just look at the difference, put the difference here. Instead, we have to go through the journal entries to really understand what is going on, okay? So first thing we have is this sales from the land. And here, how much money we actually get from sales from the land. I wanted to actually switch back to the study notes just to go over this question with you slightly. One more time, make sure you understand this. Okay, so first is the land, okay? Wanted to read this very carefully. They have this land originally cost 100,000, but sold for 90,000. Okay. Here, you can't just look at the difference between the land, because here, if you look at 80,000, you'll be like, oh, we sold the land is $80,000, but that's not true, because here, there are two transactions related to land. The first one is number one, right? You cost 100, you sold for 90. The second one is here, you have this bond issued at a par in exchange for land. So these two transactions leads to the changes in this land account. So that's why you see 80,000 here, not 90, because you sold for 90, but you also issue the bonds payable, which is $20,000, and this $20,000 you use to exchange for land. Okay, exchange for land. So here, then how much we should put for this land for cash from investing? Really, just use the transaction itself, because remember, for cash from investing and cash from financing, they're all direct method, which means we directly analyze the impact for the transaction on land. So here, two transactions. Transaction number one, when it is sold, you know it's gonna increase cash by 90,000. Okay, so that's how much should go to the cash from investing activity. The third transaction, even this is a land transaction, but the bond was issued in exchange for land. So there's really no cash here. So we don't need to consider the transaction number 3 here. Okay? All right, so let's switch back to Excel. So sale of the land, only $90,000 for the cash. Okay. All right. Now, next, what we need to look at is the building. Okay, so same thing here. You want to see how much you paid for the building. Just come back again. Look at this building. They said a building was purchased for cash. Okay, so that's the only transaction you have for the building. And then in that way, if that's the only transaction you have, you know, everything was financed by cash, you can actually just look at this increase in building. So building used to be 400,000, now it's 500,000. So increase 100,000. We know this increase is 100% paid by cash. Okay. Therefore, that's what you wanted to put here. You purchase the building for 100,000. When you purchase the building, remember, you have to pay. So we have to take it out. Okay. So that's it. That's the only items you have on the long-term asset section. Remember, we don't consider the accumulated depreciations because it has already been picked up through depreciation expense. Okay. So that gives you net cash provided by investing, and you just need to take a sum here. Okay. Any questions? All right, so if you have no question, I wanted to look at the next section, which is cash from operating section. Cash from financing section. Remember, when we do cash from financing section, we only need to focus on long-term liability and equity section. So let's come back. Take a look at this one more time. On the long-term liability and asset equity section, you have notes payable, okay, bonds payable, common stocks, and paid-in capital. Okay, here when you do statement cash flow, if you have a common stocks and paid-in capital, you can actually sometimes just combine these two as one. The reason is because if you see changes in common stocks and paid-in capital, a lot of times they're coming from one transaction, okay, just because you have this par value, so which generated this paid-in capital. If it's one transaction in statement cash flow, if they're all in the same section, you can actually combine these two accounts as one entry when you create a statement cash flow, okay? So here, we only need to look at notes payable, bonds payable, and the common stock and paid-in capital. Here, just like what we did for the investing section, for financing section, you also want to read the transaction explanation very carefully, okay? So first is the bond. They said the bond were issued at the par value for land, okay? Which means we don't need to consider this bond. Why? Because it has no cash impact, okay? Next one, they have this common stocks. They said they were issued at a par value of 50,000, but you get a 60,000 down for it, okay? And also, there's a dividends. Every time when you see a dividends, if they are paid, you know this is cash from financing activity, okay? Some students say, what happened to notes payable? There's no explanation for notes payable. If there's no explanation, which means it's kind of like a normal transaction, then you just need to look at the changes in the ending balance on the balance sheet, trying to figure out what's going on, okay? So look at the notes payable. You start with 50,000. At the end of the year, you only have 40,000, which means $10,000 is paid off, okay? To pay off the notes payable, you actually going to have a cash outflow. Okay, bonds payable 20,000, but we don't need to consider this bonds payable. Why? Because we know it was issued in exchange of land, so there's no cash activity related to bonds payable. So next one, common stocks and paid-in capital. Here, common stocks, you can see here for this transaction, the company received $60,000. $50,000 was allocated to a common stock. 10,000 goes to the paid-in because of the par value. Okay, so this true account tells you due to this issuance of the stocks, the company increased the cash by 60,000. So the last thing we need to pay attention for the CFF section is the dividends payment. Okay, so now we're ready. Let's move back to the Excel. So in Excel, we're gonna do this one by one, okay? The best practice here is try to follow the order they have on the balance sheet, okay? You don't want to like jump back and forth, confuse yourself. So first, payment of notes receivables. Second, issuance of stocks. Third one should be dividend payment. Okay, so that's what I have here. That gives you a cash flow provided by financing. Sum everything. All right. Now we needed to finish the statement of cash flow. Okay, so in the past we have students just stop there. That's not right. This is not at the end. What you need to do, you need to figure out what's the net change. How do you get the net change? The net change basically is the sum of CFO, CFI, and CFF, okay, which gives you 90,000. Next, you need to get a cash balance at the beginning of the year. Where you get this number, you get it from the balance sheet, okay? So this is going to give you a cash ending balance. Okay. Is this all? A lot of times you want to also make a note at the end of the statement of all cash significant non-cash transactions. Okay, in this case, we do have one significant non-cash transaction, which is the bond was issued in exchange of land. So you want to put that at the end of the statement of cash flow, which is actually required, so it's not optional, okay? So you just said that you have a significant non-cash investing and financing activity, which is purchase land in exchange of bond at par, okay? When we talk about this non-cash, most of the time we only talk about the investing and the financing activities. Why? Because for the operating section, we start from the net income section and we make adjustments. So all non-cash has already been adjusted. Okay. Any questions? So this is the indirect method. Any questions before I move on? All right, so if you have no question, actually I'm gonna put a name here, put a Robin. Okay. This is an indirect method. Indirect. All right. So if you have no question, I'm going to move to the direct method. Okay. For direct method, remember, we only talk about the cash flow from operating section, because for indirect method, for direct method, CFO, CFF, they're always direct method, okay? So here, let's just copy paste. I wanted to move this side, and we call it a direct method. Okay, same thing, still going to do the Robinson. And just copy and paste. And only need to do the cash flow from operating section. Okay, cash flow from operating section. Okay. All right. Okay, so far so good. Everyone has this kind of ready. Okay, for statement of cash flow direct method, why we call it direct method, which means we're going to directly analyze the transaction. Here, a lot of students feel it is intimidating because nobody likes to analyze detailed transactions. Here, I'm going to provide you some shortcut to do it in a very systematic way. If you are trying to read the textbook, you will find that the textbook is very hard to understand. Okay, so here, just trying to follow my approach, it will make your life much, much easier. So for direct method, what is your starting point? The starting point is you're gonna look at every single items on the income statement. But should only look at the items which are not non-cash transactions. So for example, if you have depreciation, you don't need to look at that because you know that is a non-cash expenses. Okay, so look at every single items on the income statement which has cash impact. Okay, so that's what we're going to do. Remember here, the key is every single items. You don't want to skip any. If you skip one item, then your statement cash flow will not be balanced. Okay. That's just a quick review. Go back to the question. just want to give a really fresh review of what's on the income statement. Okay, so income statement, you have sales revenue. Does this have a cash impact? I would say yes, most likely yes. And the cost of goods sold, yes. Salary expense, depreciation, no. So you can somehow kind of cross out this depreciation. I know I don't need to consider this, okay? Same thing here, interest expense, yes. Insurance expense, yes. Loss on land, out, okay. So I look at the rest of items. I know every single item has to be somehow presented on the statement of cash flow when I use direct method. Okay. Now let's switch back to the Excel. Oh, wait, let me cancel this. Okay. We're gonna start with the first items. For the direct method, why we call it direct, which means we have to directly explain what the cost of cash to change. So first one, we'll look at the sales. Okay, what do you think sales? How do you think the sales will impact cash? Why the cash will come from? Every time when you have sales, the most likely way sales will impact cash is you receive cash from customers, right? That's why you have a sales. Here, you can, there are a lot of flexibility on what you're supposed to write it down here, but the goal is you want to explain where the cash comes from, okay? Same thing here, when you have a cash outflow, you want to explain where the cash goes to. So we write those cash from customers. Here, how much we should put it in there? This is absolutely very important. I always tell my students is to really look at all the related account involved in this transaction. Okay, so when you have a sales, what will be the related account? I would say sales revenue. Yes. So that's what we're gonna put it down. We're gonna have a sales revenue. How much we should put it down? Key, read my mouth. The key is normal balance. We have this sales revenue from the income statement, which is positive, which means you have a positive revenue. Normal balance should be on the credit side. Okay. Now, what are the unrelated account? Question. Oh, I'm sorry. Maybe I didn't. Okay, just give me one. Maybe it's my problem. It's not your problem. So can everyone see Excel now? Yes. Oh, one. Awesome. Thank you. Okay. So now, I just put down the sales revenue, 200,000 here. Why I put a credit? Because that's the normal balance. Okay. Now think about what are the unrelated accounts when you have a sales account receivable, right? Therefore, what I do, I want to look at any changes in account receivables. Here, account receivable is actually increased. When you have an increase in account receivable, the normal balance is debit. Okay. So here I put account receivable, and the increase in account receivable here is 9,000. I'm going to put a debit account here because I know that's the normal balance. Now, to make this balanced, another account has to be cash, right? If it's not paid by account receivable, has to be paid by cash. So cash is just the difference between these two. Okay, so this is what we're gonna put it here. Cash paid by the customer. Okay, you can see what I did. I just analyzed the first items on the income statement. I think about all the related accounts, and then I look at the normal balance, try to put it there. So cash is always a plug-in amount. It's always a plug-in amount. Okay. All right, let's move to the next item. Next item we have is cost of goods sold. Same thing. You wanted to go over this again. Okay. Cost of goods sold. What's the normal balance of cost of goods sold? is debit. So COGS is on the income statement. Cost of goods sold here is 80,000. I put a debit here because that's a normal balance, right? Now I'm asking myself, when we have this transaction, what other accounts will be involved? Inventory, right? Cost of goods sold, inventory, and also what are the other accounts can be involved? Accounts payables, that's how you pay for the cost of goods sold, and also any cash if you don't have any money to pay for the cost of goods sold. Okay. Therefore, when we do this, what we're going to do is we're going to look at this normal balance for all the accounts which involved. Okay. So first we're going to look at the inventory account. So inventory account here, we have a decrease in inventory. When you have a decrease in inventory, we know what is the normal balance. It's going to be credit. Okay. Inventory decreased by 20,000. 20,000. Okay. So what else we have? We want to see accounts payable because that's the way you pay for the accounts receipt, cost of goods sold, right? So look at the changes in accounts payable. Accounts payable here, you have a decrease. Decrease in accounts payable. What's the normal balance? Normal balance is debit. Okay. Now remember the cash should be always a plug-in amount. To make this balance, the cash has to be on the credit side. I take all the debit, I subtract the credit, which gives you 65. Okay, so here, what I'm supposed to write here, remember you want to write where the cash come from and where's the cash paid to. So here is cash outflow, you want to say cash paid to the, I would say, suppliers, right? That's why you pay. You go out to buy the inventory. And so that gives you something like 65,000. We can make it as a elective because this is kind of cash outflow. Okay, any questions? Then let's move to the next items on the income statement. We did a cash from customer, cash from suppliers. So next one is going to be the salary expenses. Same thing here. You want to think about what the normal balance. When you have these salaries expenses, normal balance is always going to be debit. Okay. So what's the credit here? Think about all the related account. If you have this accounts payable related to expenses, that's why you can use it here. But if you don't have, and all the accounts payable has been used up when you do the first journal entries, then you don't have any unrelated account. The only related account you can have is cash, right? If you don't have any accounts payable, it has to be cash. So I have a student come here, they ask me, say, how do you know where this accounts payable goes? In reality, you can look at the past journal entries. You can see exactly how much accounts payable goes to the cost of goods sold and how much accounts payable are used for the salary expenses. But when you're doing homework, when we're doing exams, we don't have the access to the detailed transactions. So what do? Is you are always allocated to accounts payable to cost of goods sold transaction first. Okay, whatever you have left, you can allocate it to the next item. That makes sense? But in reality, you should be able to always look at the past transaction to see exactly how much accounts payable goes to where. Okay. So here, since we already used up all the accounts payable in cost of goods sold transaction, and let's here assume everything you have here is paid by cash. Okay. Same thing. We want to really write out what are the cash for. So we should say cash paid to cover salary expenses. Or you can write it as a cash paid to employees. That's perfect fine. Like I said, you have a lot of flexibility here. The goal is to clearly identify where the cash comes from and what's the cash paid to. Okay. Here, I'm going to be. Any questions? Let's move to next item. So next item is interest expenses. Like I said, since you don't have any accounts payable or left, you don't have an interest payable account. So we can assume all the interest expenses are covered by cash. Okay, so that gives you 3,000. I know this interest expense is going to be on the debit side because that's the normal balance. Okay, so here you have this cash paid to cover interest. Okay, keep reading. Next one, we have insurance expenses. Same thing here. You ask yourself, what are the possible accounts involved in this transaction? I would say certainly insurance expense. The normal balance is going to be debit again. That gives you 1,000. What are the other accounts? Any like payables related to say insurance payable, which we don't have. Okay, but prepaid insurance. Do we have a prepaid insurance? Yes, we do. It's on the balance sheet. So you look at the balance sheet account to see it's increase or decrease. Here you have an increase in prepaid expense. So ask yourself, what's the normal balance? Normal balance for prepaid expense increase is debit. So yeah, prepaid expense is going to be debit. And 2,000. Okay. So the last account which can be involved is going to be cash. It's just the plug-in amount. Okay, since this two debit, or cash has to be credit. Okay. Here you can just say cash paid to cover insurance. Or cash paid to insurance company, because here you have not only the insurance expense, but also you paid some prepaid expenses too. Prepaid insurance expense. So that gives you a, like to 3,000. Okay, so the next items we have on the income statement is the income tax expenses. Ask yourself, what are the possible accounts can be involved in this transaction? We studied in chapter 19, right? You can have income tax expenses, you can have income tax payable, you can have any deferred tax, and you can have cash. Okay, so we're going to look at all the accounts we have. First, let's start with this income tax expenses. So I have a question coming. Yeah, you're right. It is not prepaid insurance is not an expense. It's just called a prepaid expense. But this is still going to be debit normal balance. Make sense? So even prepaid, that's why we look at the 2,000, which is the change, not the item itself. Okay. But the prepaid insurance expense is not an expense, even it's called a prepaid insurance expense. Okay. Same thing with unearned revenue. Unearned revenue itself is not a revenue. It's a liability, but we call it unearned revenue. Okay, so sometimes you may have something called expense, but it's not an expense. Okay, so next one, income tax expenses. Here, normal balance is debit, which is 18,600. I take this number from the income statement. Now, look at the balance sheet. I'm trying to see, is there any deferred tax, which we don't have, but do we have any income tax payable? The answer is yes. Okay, so income tax payable, we have increasing income tax payable. Ask yourself, what's the normal balance when the liability increase? The answer is credit. So here we're gonna have this income tax payable that is on the credit side. And that just gives you 26. Okay. So what we have left is cash. Cash is a plug-in number. Debit minus credit. So cash paid to IRS. You wanted to put this as a cash paid to IRS because not everything covered expenses. You also have some like a payables, something like that. Okay, so here cash paid to IRS, exactly how much you pay, 16,000. That's it. Then what do? You just add all this together. Just to save time, copy paste the title a little bit here. And use the sum. What you want to see is this number should be exactly the same as what you did when you do the indirect method, okay? So if you didn't get the same number, which means something wrong with your calculation, okay? So a lot of times it will happen. You may find that it's actually quite usual when you do direct method, you find some number which is different from indirect method. The possibility is a couple of questions. First, sometimes the company they may not separate depreciation expenses from other operating expenses. So when you have like operating expenses, you didn't really see which portion which are not cash expenses. So if you have a company that's not separate depreciation expense or other non-cash expenses from normal operating expenses, you have to separate it first, okay? The second possibility why you don't get the same number is you may skip some of the account, okay? Like what I said, you wanted to get a little pen, mark every single items on the income statement, make sure they has already been taken care of. Okay, so the relationship here is everything you did on this direct method has to match the changes in the current asset or current liability. So say after you did all this homework and you find that some account on the balance sheet, the current asset, the current liability section is not used, okay? Then that should give you a signal something is wrong. And then you need to go back and look at that account, think about how that account is going to be linked to the items on the income statement, okay? The goal is to want to make sure every single items on the income statement, every single items on the current asset and the current liability section has already been considered, okay? Otherwise, you are not going to get a balanced CFO. Okay, any questions? If you have no question, let's do one more question together, okay? Remember the Norman question we did the last class. I wanted to do the same thing again by looking at the indirect direct method, okay? So Norman question. This is also on the study notes. I kind of forgot which page it is, but it should be find out easily. So this is what we did the last time by using the indirect method, okay? You should be able to find this from your notes taken last class. What we're going to do is we're going to, for this question, we're going to do a direct method. So this is an indirect method. Lazy, so just do here, do a direct method. here, since we only do the operating section, so you only consider the current asset and current liability section. So current asset and current liability. Remember, everything you have on the long-term asset, they all goes to the investing section, so you don't need to consider it, okay? So that's the chat question coming. I just want to emphasize this one more time. CFO is about the income statement, current asset, current liability. CFI is about long-term asset. CFF is about the long-term liability and the equity section. That makes sense? Yes? There are only two accounts we don't need to consider, which is the cash and the return earnings. Okay, so now let's go back to the Lorman company. We are going to do the direct method. Same copy and paste to get the company name down. Okay, direct method, right? We only need to thinking about the operating section, which is awesome. Okay, now what we're going to do is you're going to analyze the items on the income statement one by one. Okay, one by one. We only need to consider the items which are which have a cash impact, which means every time when you see a depreciation expense, amortization expense, you can cross them out. Or like loss and gains from sale of asset, sale of investment, cross it out. Okay. I wanted to also emphasize this a little bit. This is like a common mistakes I find it in a student is if they have like sales and PP&E, seems very easy for them to understand that is an investing activity. But when they have sales of investment, like say sales of bonds, sales of stocks, a lot of students don't think they are investing activity, but they do, okay? Think about that. We studied in the prior chapter for all bond investment, for the stock investment, they're all what we call long-term investment unless they were classified as trading, okay? If they're classified as a trading, we count them as an operating section. If they're not, that goes to the CFI. A very good way for you to really review this, especially about the long-term asset, long-term investment section, is to combine what we have in chapter 23 to chapter 17 when we talk about the investment. And remember, in the investment, we actually look at the held to maturity, available for sale, and trading. We talk about exactly where it goes in the statement cash flow section. Okay. Statement cash flow section is a very important section if you are thinking about taking the CPA exams. So I will encourage you to spend some time and really understand what is going on. And also, personally, I really like this statement. It's very beautiful. It's a flows from statement to statement to really show you how to say the beauty of accounting. Okay. So if you're going to choose this as your profession, then I hope you really also appreciate this beauty of the accounting, see how the financial statement they actually connect to each other. Okay, so now look at this Lorman companies. You start with a cash flow from operating section, and we're going to look at the items on the income statement one by one. First, we're always going to start with sales. So here, sales follow the normal balance. Okay, so revenue, normal balance, credit, 840,000. Okay, you want to put a credit here. Now, remember, related account can only be account receivable or cash. We look at account receivables. So this time, account receivable decreased. Ask yourself, what's the normal balance when account receivable decreased? We have to put on the credit section. Yeah. Okay, so here you have a credit, 22,000. Okay, and what do we have? Cash. Cash has to be a plug-in number here. So that's debit. You're just going to write this as a, just copy this a little bit. Cash from customer. That's how much money you receive from the customer. Okay. Next, we're going to look at the operating expenses. So here, the operating expenses, normal balance is going to be debit. Um, 624000. Okay. Here we don't have a cost of goods sold, and therefore we could just look at the accounts payables, because if any accounts payable you have has to be used to pay for these operating expenses. So here accounts payable is increasing 15,000. Increase accounts payable always credit. Here debit, accounts payable credit. Next one is cash. Cash is a plug-in number. All right, every time just remind yourself, income statement account, use exactly what you have on the income statement. Balance sheet account, always use the change. Okay? So here that gives you cash paid for operating expenses. Okay. So next one we have is the depreciation, which we don't need to consider because we know depreciation expenses themselves has no cash impact. And next one we have loss on sales. Here also it doesn't have a real impact on the cash flow from operations. But I do want to actually just write it out, what the journal entry is supposed to be. Now you can see why it should have no impact. Because when we have depreciation expenses, what are the normal journal entry? Normal journal entry looks like this: depreciation expense, whatever the numbers is, and where it goes, cumulative depreciation. Okay, so this is the normal journal entry will be involved. You can see this journal entry, there's no cash account. So next one, you have this loss on sales. Same thing here, you wanted to really write out what do you think the journal entry is gonna be. When you have a loss on sales, the normal transaction is you have a certain investment and you sold it. And so you have a loss on sales. And let's say you have a PP&E. With accumulated depreciation. Okay, so what's that transaction gonna be is when you have a sales, you're gonna remove whatever the PP&E you have from your book credit. Then you also remove whatever the accumulated depreciation you have related to this transaction. Because you remove the accumulated depreciation, you are gonna debit. Why debit? Because the normal balance is a credit, so you wanted to remove it, you have to debit. Okay, and so this is you remove it from your book, and also normally when you sell this PP&E, you're going to receive cash. Okay, so you're going to receive cash, and also in this case you have a loss, right? When you have a loss, what happened is, which means the cash you receive is less than the book of money you have on the book. So you're gonna have this loss on sales. So this is the transaction, the journal entry you will have when you have this sales on PP&E and have a loss. And here, the normal, the common mistakes is we have a student that will take this cash, put it there, but this is not where you should put it. This goes to the CFI, okay, because this is investing. And this one is what you have on the income statement, but it has no cash impact. So we don't need to consider accumulated depreciation, PP&E, they're on the balance sheet. So you can see here, even you have this loss on sales on the income statement, this transaction itself should not impact cash from operating section. Okay, so that's why we don't need to consider that. All right, So what we're gonna do is we're gonna look at the next items. Next items we have is called income tax. Income tax expenses. Now we're going to look at the income tax. Look at a couple of transactions. First, income tax expenses, which is 40,000. We know the normal balance is a debit. And the next one, you have to think about what are the related accounts on the balance sheet. In this question, we have one related account on the balance sheet, which is income tax payable. Okay, here, very important, look at the changes. The changes is income tax payable is reduced. So when you reduce liability, what's the direction you should put on the debit side, So here, income tax payable, 45, also on the debit side. Cash is going to be a plug-in number. Has to be on the credit side. Add all this together. Okay, perfect. And you can see here you have a cash payment, and that will be cash paid to IRS. Make sure you put elective number here. You can see here why we call this a direct method, because you directly explain where the cash goes. Okay, so that gives you a cash flow from operating sections. You can see here, well, very lucky, we get exactly the same number, which means we did everything correct. Okay, any questions? Good, everyone feel okay? So we have a little bit of time left. I would like to do one question, one more question, super simple. Is just basically look at the one question we did in class about the tax consultant. So for that, the tax consultant, see here, we had a very simple statement of cash flow. And I wanted to just make this complete to also do direct method for the operating section. Okay, so I have this, maybe slightly different from whatever you have on your study notes. So this is about the tax consultant, but this is the first year. But this is the first year. And what I'm going to do is I will just look at this operating section, then very quickly do a direct method, okay? So, anything here, even copy paste. If you don't have this, it's fine. I just wanted to make it complete to make sure we feel comfortable, okay? All right, so this is an absolutely very simple question. They only have very few items on the income statement. Even have no depreciation expenses. What do we need to do? We just do this one more time, like what we did. We look at the cash from operations, and we're going to start with the first item. First item is sales. So that's what I did. I look at the revenues, and I look at the changes in account receivables, and then I figure out the cash, which is a plug-in number of 89,000. And like what I did in the past, you want to separate this as a cash from the customers. That gives you 89,000. Okay. You can just mark next to your study notes. I know the study notes for your indirect method is already provided for you. Okay, so you can just really write it down what the direct method is going to be for the first year. Okay, so that's cash from customers, and the next one is going to be operating expenses. Same thing here. You are going to look at the accounts payables, look at the account operating expenses, and then figure out this plug-in cash. So that gives you cash paid for the operating expenses. The last items we have for this question is income tax expenses. So here, I don't have any accounts payable left. Okay, so everything we have, you don't have like income tax expenses or income. You don't have like a tax payable or deferred tax. So everything you have in this income tax expenses has to be paid by cash. Okay, so that's what we have here. Then we just need to copy paste as this gonna give you a 3,000. So this is consistent with what we have by using indirect method. All right, any question?